Hi, guys. This is Tim Melvin of the Flagship Report. I want to come to you today, and we're going to be doing a series of these to cover each of the four portfolio sections and kind of explain exactly what they are and what you can expect. And I want to start with the small cap momentum investing portfolio. This was the first one we added on top of the original portfolio because I understand that when you're at different points in your life, you have different investment needs. We do a lot of number crunching around this shop, and we've tested a lot of things, and everything kind of comes back to momentum and value separately, not together. But and I want to start with the small cap momentum because this is the area where you can really accelerate returns over time. This, along with small cap value investing, which we'll talk next, are for those that are really in the let's accumulate money rapidly. I don't care about income. I need to earn the highest possible return that makes sense, I guess is the way to put it. So let me just kind of jump in. We're going to take a quick overview of exactly what momentum is and isn't, and exactly how you can use it the way we present fundamental small cap momentum in the flagship portfolio, flagship report portfolio. Now, look, momentum's been around for a very long time. It's not a new introduction. It's not something that was just discovered, although the research reports didn't start showing up until the 80s and 90s. I mean, we can go all the way back to right around the year 1700 during the Napoleonic Wars. David Ricardo, one of the great classic economists, made an absolute fortune trading British government bonds. Ricardo had a simple philosophy, and he very famously declared, and he was the first one to declare it, and we've all heard it a million times since, ignored it, but heard it. And that is cut your losses and let your profits run. If we could distill all of momentum investing down to one phrase, that is it. And it didn't stop there. I mean, if we all hear about the tulip mania, right? And we know that the tulip mania that happened in the 1630s in Holland is an example of one of the great bubbles and busts of all times. And it's usually used as a metaphor for markets that have gotten overly frothy. You have to remember there was a period leading up to that where tulips went up constantly. And there were a bunch of merchants and traders that tracked tulip bulb prices, for right or for wrong, and borrowing money to buy those whose prices were going up the fastest. A lot of them made an enormous amount of money before the bubble burst. It's the same thing with the Dutch East India Company. A lot of traders in the Dutch East India Companies noticed that when they announced certain voyages to certain areas, or they made a dividend announcement, the price of their shares appreciated strongly and rapidly. Now, these were called momentum lists, which were just nothing more than uh, an early 17th century version of high relative strength screens. Same thing, 18th century London, the South Sea Company and the East India Company. The shares were traded by folks who kept handwritten charts of price action. They bought strength and they sold weakness long before anybody thought to call it momentum. And then where momentum really comes into the modern genre is Jesse Livermore. Jesse Livermore, in the early 20th century, he started as a chalkboard writing prices on the walls of Boston bucket shops. And he quickly noticed something that nobody else seemed to be aware of. Stocks that made new highs often kept going higher. So he started buying those names as they broke through to new highs, and he would pyramid his position as long as volume and price were confirming the move. His rule, be right and sit tight, is the definition of riding momentum. Now, in terms of 1929 dollars, his fortune peaked at around $100 million by riding all of the big trends of his time. He made a fortune being short in the 1907 panic. There was a huge commodity boom during World War One, and Livermore made an absolute fortune. And of course, in the Roaring Twenties, he made a ton of money. Now, what Jesse did not understand was risk control, as he was as apt to go broke as he was to make a fortune. Now, fortunately, risk control has gotten a lot better. Then there was Charles Dow, who started out as a journalist, and he noticed that markets tend to form trends. And between 1899 and 1902, he published several essays on how there were primary, secondary, and minor trends, which is still part of the market momentum theory and market structure theory that you might hear talked about today when momentum investors get together. Then, of course, we had the ticker tape readers of the 50s and 60s. Um, and you had guys in the 20s and 30s, I'm sorry, like Nicholas Darvis and Bernard Baruch, that took the Livermore model of reading the ticker tape and buying the things that were going up and selling the things that were going down. And they both got filthy rich doing so. After World War II, you had a lot of economists, James Tobin, Eugene Fama. They assumed originally out of the box that markets were very efficient, but the data kept saying, no, they're really not. So we had DuPont and Thaler and Jagadish and Titman and others demonstrating clearly that past winners continue to win for several months, proving with science what David Ricardo and Jesse Livermore already knew by standing in the markets making the trades. We've got a lot of systemic momentum funds today. Richard Driehaus, AQR, a whole bunch of others. Louis Navellier is one of the masters at this. He's been doing it since the 1970s. And he and Driehaus were the ones who originally pinned it to the point in stocks, particularly small stocks. It's fundamental momentum that drives price momentum. If you have a company that is excelling, the business is fantastic, it's growing, and institutions are buying and piling into it, that is what ultimately drives price momentum successfully. So momentum hasn't been around for a while. It's been around for a very long time. I'm just going through all the parts of the slides of what I just read, just because I got carried away. So small cap momentum combines two of the most powerful effects, right? The size and momentum effects. What we're doing in small cap momentum is we're selecting small cap stocks that have exhibited strong performance over both short-term and longer-term time periods. That's it. We're adding some other filters in that we'll discuss here in a minute. But that's really all that we're doing. When you look at the Jagadish and Titman study and French Fama, they were the first ones that kind of broke through. And Fama French in particular, you can go to the website today that Eugene French, I believe I think it's Fama that runs the website now that I think about it. But anyway, it's just Google for Fama French factors. And they put together a lot of things, value and momentum and quality. And they found that two of the best were small cap along with momentum. Smaller stocks that are exhibiting price momentum are one of the most powerful factor combinations in the history of markets. Look, the behavioral biases are stronger in small caps. All that means is the fear and greed cycle is magnified. When people get scared and they're dumping, they go too far this way. When they get too excited, they jump into it. The same token, smaller caps don't have, our stocks, you'll find them, maybe there's an analyst, maybe there's two or three, maybe it gets talked a little bit about on some chat boards in some corner of the internet, but it's not right there in your face with 57 analysts and being the subject, lead subject on Twitter, on Facebook, on Reddit, and everywhere else that stocks are talked about. So the information spreads a little bit slower, and it takes longer period of time for all of the information to be fully reflected in the price, giving you time for the buying pressure of people making the discovery to continue to move into the space. One of the things we like it a lot, one of the reasons I like it a lot, is there are institutional constraints, right? Fidelity's not coming in here and clean out all of the offers. They would quickly run into legal problems with percentage ownership because we stay very small with our portfolio. We are generally a billion and under, and usually way under in market caps. So we're not competing against Stanley Druckenmiller or Paul Tudor Jones or Fidelity or any of the other massive funds. This is an area that's more reserved for institutional investors who take the time to learn the ins and outs of the smaller cap market. And absolutely, there is a supply demand imbalance. While it may be true that a $50 billion stock going to a $70 billion stock is exactly the same 40% return, it takes a lot less buying pressure to push a 500 million market cap to 700 million than it does to take 50 billion to 70 billion. So supply and demand imbalance is there. When these stocks get popular and money starts moving into them, it can come in aggressively and overwhelm the amount of stock that's available for sale and push the stocks dramatically higher in a very short period of time. So now look, what are the risks? And there are some risks. Anybody that does an investment strategy and says there's no risks is he's lying. Look, the volatility is really high. It's nothing for us to see portfolio moves between 5 and 10% on a monthly basis, and that's on a 25 stock portfolio. Individually, the spread's much bigger. We've had months where we've had a handful of stocks that were up 50% or more, and a handful of stocks that were down 20 and 30%. That's not abnormal at all. In fact, it's quite normal. The volatility of these stocks is really high. Now, there can be momentum crashes every once in a while, and it doesn't happen. It happens every few years, right? You get a period where momentum just absolutely crashes, and it's usually because all the liquidity is sucked out of the sector. There's fear, there's economic problems. Whatever the reason, momentum crashes, and it crashes big. Liquidity risk, we view liquidity risk as a liquidity opportunity. It can be a problem, but not at turning points. There's usually plenty of liquidity to take an opposite position, which is generally what we're doing. And it does tend to get quite concentrated in segments, right? When money is flowing into AI, it's flowing in across the board. So you will get concentrated in certain sectors. Now, the cool part is generally you're going to see the opportunity in the smaller stocks before you see it in the larger stocks. You're also going to see, and we're seeing this in AI now, and you see it in just about any other hot segment of the market, energy, whatever it is. The big players are going to buy the small players, and they're going to be looking to buy the best small players. The best small players have the best combination of fundamental and price momentum. So there tends to be a fair amount of M&A activity that's very favorable for us. Now, we do deal with the momentum crashes. Momentum crashes are usually preceded by a combination of two things. One, really high valuations. Now, generally speaking, valuation expansion is good for us. When PE ratios are going higher and higher and higher, that means the stock price is going higher and higher and higher. So, unlike in a value portfolio where that would be disconcerting, it's not that disconcerting here, but every once in a while you see that we'll do another presentation on this, but you'll see a period where credit spreads, which are the best measure of overall risk, are very tight and compressed. There's no fear. There's no complacency. Nobody's scared of anything. And valuations are reaching extreme peaks, kind of like now, just to be completely open about it. When that happens, and if the market corrects, there's a piece of bad news that causes credit spreads to begin to move higher, and valuations are already high. The crash can be pretty epic. I mean, and we saw this in 2008, 2003. We saw it for a brief half a second in 2020. The drawdowns can be awe-inspiring, to put it bluntly. However, there is a way to protect yourself from that, and we use it. When we have this combination of really tight spreads and really high valuations, we find that it just makes a little sense, because at that point in time, insurance is really cheap in the stock market. And what's really cool is you can actually wait till the fire starts. Most of the time, you can wait till credit spreads make the first little move off of the bottom of the tight range and buy insurance in the form of out of the money options very cheaply. So What we're going to do is we're not going to protect ourselves against day-to-day swings in the market. Remember, this is a volatile strategy, so we're going to give it a rim. We're not worried about 15 or 20% swings. Those are normal. We're worried about a momentum crash. So we're going to go way out of the money and we are going to buy some put options. This is a strategy made famous by Nassim Taleb, Mark Spitznagel. Um, we have seen the folks at Saber Capital use it very successfully to make just a ton of money in 2020. So it works. It's been tested. It's for protection against extreme events, and it pays off big when we have an extreme event, which does something else besides just provide a hedge. When you cash in the hedge, it gives you cash. You now have cash to deploy at the bottom of the market, which the way we do things in the flagship report with both the momentum, and as we'll talk about in a few days, the value strategy, the opportunity for massive life-changing returns is there, and it has a high probability of success, and you've got cash. That's a great combination. That's how we use black swan hedging strategies. Now, I'm not a stranger to black swans. Back in January 6, 2020, I was writing a column, a twice a week column at Money Map Press called Max Wealth. And on January 6th, 2020, I wrote instructions on what I wanted you to do to construct a black swan trade. And that was to go all the way out to 2022 and buy the put options on the S&P 500 and call options on the VIX volatility index. And I wanted you to do the same thing, long dated, way out of the money, low priced options. I had no idea that COVID was going to come to the United States in the form and impact that it was eventually made. When I wrote the column, we were actually talking about rising tensions in the Middle East and the fact that some people were afraid that was going to cause disruptions in the market. COVID was just a dot on a blip and a problem in Asia and a little bit in Italy. We were starting to hear the first waves, but nobody really thought it would be a big thing here. We had no idea it was going to cause a 40% correction in markets. Those who put on a black swan slept like babies, cashed in at the bottoms, and had a ton of cash to put to work right as that market got ready to reverse because Congress and the Fed and everybody else just dumped a whole bunch of money on the world. We'll let the historians sort that one out. So black swan hedging does work, and the conditions are they are actually easy to spot. They're not always going to immediately lead to a correction, and you have to look at this as low cost, low price insurance, and you're only putting a tiny percentage of your portfolio, maybe 0.5 to 1%, into the hedging strategy. If they don't pay off, fine, you paid a small insurance premium. If they do pay off, you protect your net worth and you provide yourself with a bunch of cash to deploy at the time that makes the most sense. So we're big fans of black swan hedging at the flagship report. Of note, I wrote this just last month in the report. We like our companies, we like the fundamental momentum, and we like the way we're positioned in the portfolio. However, we can easily be taken down by market risk, and we need to take steps to avoid that outcome. So right now, the market has gone from friend to foe, and we need to take steps to protect our flagship as we continue on the journey. And we're still recommending that if you don't already have one put on, it's not a bad time. It's going to be, things keep going the way they go, it's going to get to be one pretty quick. But just having it in place to protect against the momentum crash when conditions suggest that the probability of a momentum crash has risen to levels where the trade makes sense, we will put on a black swan hedge to deal with that particular risk. So how do we do this? We start with momentum screens, and we do screen for fundamental as well as price momentum. We're going to look for very small market capitalization. This is a high turnover strategy. We rebalance this thing every monthly, and it's simple. We're going to cut ties with the losers. They start winning again, they can come back, and we'll hang on to the winners. It's just that easy. We're doing basic momentum investing here because it works. And we do have quality and value overlays that we put on the stocks in the portfolio. We're not going to buy garbage that's just a story that has no earnings, that has no profits, that has no prospects. And we do have a value factor that we put in there because we don't want to buy stuff that's so ridiculously priced that there's no chance of us making money. So we do have some small quality value overlays that we put on the portfolio because they improve and enhance the overall performance of this thing. Now, before I get into the year by year annual returns, I'll come back to that. Don't worry. You need to know that none of this is done on my opinion, my bias, how I felt when I got up that morning. This is all quantitative. It's driven by models that are fed by decades worth of data. We have been crunching this data for years. We crunch it every week on another basis. We retest. We do not optimize. I think that's silly, but we do test. We make sure that everything is still working the way it's supposed to work. So it's 1000% quantitatively driven, not qualitatively. We did the work on the front end. From there, we let the machines do it because that works better and it takes fear and greed. It turns fear and greed into our best friends, and they're no longer our enemies. So it is 100% quantitative strategy. The year by year, here's the annual returns. You can see there's been some big years. There's 2008 was a bad year, but the market was actually down worse. 14 of the last 20 years, this has outperformed. I'm sorry, 16 actually of the last 20 years. This has outperformed the S&P 500, which is pretty impressive streak for a small cap strategy. More importantly, you'll notice that we are now getting ready to be on our second year of underperformance of the S&P 500. 2024, we didn't underperform by much. It was not a bad year by any stretch of the imagination. But the last time we had 2 years of underperformance, over the next 3 years, you grew your money by 2.5 times. Every dollar was worth $2.50. So when it's been out of favor and underperforming a little for a while, the reversion tends to be dramatic to the upside. And a lot of this has been driven by the large cap bias that's in markets. We think that cycle is getting ready to change, and we're getting ready to go into a long small cap run like we saw after 2009. Here's just kind of the numbers. This is going back over the last 20 years. Small momentum has earned more than double the S&P 500, 22.5%. It has been more volatile. I told you this is a volatile strategy, and that's a good thing because we can make volatility work for us. That's not the last time you're going to hear me say that. The max drawdown, steep, 60%. Versus the S&P 500. This is without using black swans. If you use black swan strategy, that drawdown becomes much less of a thing. Here's the Sharpe ratio, just measures how much risk you're taking for each unit of return. We're 50% higher, which means better. We're taking less risk to produce more return than you are if you just buy the index fund. And by the way, correlation, that means how this moves when the S&P moves. It's really low. It's just not. This can work when the market is not working. There'll be times when the market's working really well on the large cap side where this isn't working as well. So it is a non-correlated asset with the S&P 500, which is kind of like finding the Hope Diamond in your dresser drawer by accident. So you've actually got, great raw returns, very attractive risk-adjusted returns from this small cap momentum strategy. Now, small cap momentum tends to perform best during periods of economic acceleration, early bull markets, and improving liquidity conditions. This is not an early bull market. However, liquidity conditions are improving. That should continue all the way through 2026. We do have renewed capital investment coming in infrastructure, energy, reshoring, technology, and all of small cap companies are in all of these areas. And by the way, we own some of them. The environment we're in historically is very supportive of very strong multi-year momentum cycles in smaller companies. We touched on that. I think we're getting ready to go into a small cap bull run, and small cap momentum is going to be the leading strategy in that particular bull run. So that's kind of where we are, guys. The small cap momentum strategy is for the investor who feels like they're behind and they need to maximize their opportunity to earn returns at a much higher rate than the S&P 500. They need to compound at a higher return. They can also deal with some volatility because it's going to be volatile. And by the way, anybody that tells you I got a super high return strategy that doesn't have enhanced volatility is, again, probably lying to you. Now, in addition to the investor that's looking to accelerate returns at the highest rate possible, there's another class of investor who will find the small cap momentum strategy of interest. Now, there is a famous story, I believe it was in one of John Spooner's books on being a broker, where the broker is meeting with a client. I'm going to call the client Irv because I don't remember, but Irv comes in and they're sitting down and talking, and Irv's got a chunk of money. He's just sold a factory. He's got some bucks and he's been looking for a new broker. So he sits down with the broker, who we'll call John, because I'm pretty sure it's in John Spooner's book, Sex and Money. It's either that or Confessions of a Stockbroker, one of those two books by John. So anyway, John is talking to Irv, and he's like, look, Irv, I've been talking and you keep, do you want to make money? I mean, what's your major concern here? Are you here to make money or are you here to screw around, Irv? Irv says, well, John, when you put it that way, to be honest, I'm here to screw around. It's, look, I sold my factory for millions. I got more money than I ever thought I would have. I got most of it in municipals at a really good rate. I just collect the cash. It's like my wife doesn't want me hanging around the house all day. I drive her crazy. So I come down to the broker's office. I want to trade a little bit. I want to feel like I'm in the game. I want to enjoy the action. The small cap momentum portfolio is going to allow you to do that because there is high turnover, there's high returns, you're going to be in the stocks with great stories. The difference is instead of just trading options that have an expiration, you're in stocks, companies that as they keep going higher, we can keep riding them. And there's no expiration date on a small cap stock. I read a great story not long ago about a shipping executive. And he was basically saying, look, this is a high risk, high return business. Anything I can do to move out my y-axis, extend my period of time to stay in the game, the higher my chances of hitting the big one. Exactly the same in small cap stocks. If you're looking to speculate a little bit, to be more aggressive, we're going to take the expiration cycle out of it compared to short-term options trading. We're going to move out the y-axis. We can stay in this as long as the stock is running. This is real simple, guys. This is cut your losers, let the winners run. And we use that goes for fundamentals as well as the price momentum. If we have a stock in our portfolio where the fundamentals begin to deteriorate, we're going to wave bye-bye to that one, just as we would as if the price started to roll over. So this is, again, for investors looking to earn a much higher return, or those who just are really attracted to the idea of trading a portfolio of small cap stocks. So that's my presentation on the small cap momentum portfolio. It is not for everybody, but if you're looking for higher returns, you can handle some volatility. It is absolutely 100% for you. And again, because it's quantitative, that we don't have bias, we don't have opinions, we just have facts and data driving the decisions, which gives us a huge edge because fear and greed is now out of the picture, and instead of being obstacles, are tailwinds. Thanks, everybody. We'll talk again real soon. Next time I'll be back and we'll talk about small cap deep value.